Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Along with my colleagues bringing a variety of perspectives, today I'll be talking about the consequences of elections on policy and markets. It's Monday, July 8th at 2:30 p.m. in New York, so let's get after it. Several important elections around the world have taken place, with important implications for policy and markets. Most notably, elections in India, Mexico, the UK, and France have all garnered the attention of investors. While these elections are unique to each country, there does appear to be a growing focus on the issue of economic inequalities and immigration. While these inequalities have been building for decades, the COVID pandemic and policies implemented to deal with it have ushered in a higher focus on these disparities and a general level of uncertainty about the future on the part of many citizens. Of all the changes affecting the average person most adversely, inflation stands out as the most challenging. While the rate of change on inflation has been steadily falling since 2022, the price level of a number of goods and services remains challenging for many. Prices for basic items like food, shelter, healthcare, insurance, and utilities are 30 to 50% higher than they were pre-pandemic. Offsetting some of these increases has been the rise in home equity and financial asset prices. But this only helps those who are asset owners. Fixed-rate mortgages have also been a notable positive offset to rising prices and interest rates. For many, there's a natural arbitrage between these pre-existing, historically low mortgage rates and money market rates. Once again, such an arbitrage is only available to those who have large piles of cash. In our view, these dynamics further the case that inflation is going to play a major role in this year's upcoming U.S. election, much like it is having an impact globally. The recent U.S. presidential debate prompted inquiries from investors on what a potential Trump win or potential Republican sweep could mean for markets. Based on initial market reactions and our conversations with clients, there's a consistent view that both growth and longer-term interest rates could move higher under this outcome. This has led to a greater appetite to rotate one's equity portfolio towards value and cyclical stocks, which also worked leading into the 2016 election. Market expectations for fiscal expansion, reflation, and less regulation under a Trump presidency support such moves. However, we think there's also a couple of important dynamics to consider. First, we would argue that the cycle is more mature today than it was in 2016, as evidenced by the 2.5-year decline in the Conference Board leading economic indicator and the nearly 2-year inversion of the yield curve. Given a later cycle environment is historically a backdrop where the market pays up for quality and liquidity, we advise staying up the quality curve and away from small cap cyclicals, which worked in 2016. In short, the state of the business cycle right now is more important than the election outcome. As such, we think investors should stay selective within cyclicals. Second, the market welcomed a reflationary playbook in 2016. Inflation was not a headwind to consumers in the way that it is now, and the U.S. economy was recovering from a global manufacturing recession, the recovery of which was aided by the prospects of a pro-fiscal, reflationary policy regime. Today, inflation is a notable headwind to consumers, as discussed previously, and fiscal sustainability dynamics remain top of mind for the bond market. Thanks for listening. If you enjoy the podcast, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.